A very good evening, everyone. Welcome to Admiral Markets. My name is Chris, and together with Nanette Tarantula, we're going to take a look at trading trend reversals in the Forex market in today's webinar on the 5th of November. Before we dive into the topic, though, be aware that this webinar is intended for a global audience, yet may not be suitable for everyone. Therefore, take a look at admiralmarketsglobal.com, select your country of residence and contact an appropriate entity, and find out more information about that and other conditions and details. Also, be aware that trading for exchange and global financial markets is considered high risk and may not be suitable for everyone. Therefore, please seek the advice of an independent financial advisor for more information on that. This webinar is not advice and is for informational and educational purposes only. And by continuing watching this webinar, you agree with this disclaimer, plus you are aware of the risk involved when trading. Alrighty, so thanks for your attention on that. Admiral Markets is the host of today's webinar, and take a look at admiralmarkets.com after the webinar. You can take a look at many things like analytics. You can find out more about the education that is provided, but also about Supreme Edition. As you know, a lot of extra features included in this MT4 package, and that probably one of the good reasons why Admiral Markets won the Broker Award this year. So take a look at that. A lot of things included in that, from various analytical things like the correlation matrix and the now I forgot the correlation matrix. We got the calculation lot size, of course, as well. We can take a look quickly here. Actually, you can see on the left side a lot of that correlation, the mini terminal, the tick chart, and the alarm manager. All right, so that's all very useful on the left side of this MT4 platform. All right, so the process of trading trend reversals is, I think, interesting because it's a bit exciting. I think trend trading, well, many traders I think like reversal trading. It's maybe a bit natural to try to look and find them to a certain degree. I think traders like to catch the turning spot. So from that point of view, it's appealing, and it's not easy. So it's a bit of a challenge as well. So we're going to talk about a few things, and then I'll pass it over to Ned, and he'll discuss his thoughts about this. I think it's basically these things we want to discuss is what is the trend? Obviously, when we're trading against the trend, we got to know what the trend is so we can trade against it, and also know at what spots might be the best ones, and how can we really literally look for those potential entries. So that's what the focus is going to be for tonight, from my point of view. I hope the sound is good. Is the sound okay for this moment? Do you hear me properly? Cool. Great. Thanks for that confirmation there. So what is the trend? Well, I look at higher highs and higher lows and lower lows, lower highs. Obviously, just the classical way of looking at the trends, trend channels, moving averages, and I also look very closely at momentum and correction. And these things we're going to take a look at quickly before we talk about reversals, first of all. So how do we know if a trend is present or not, or whether a correction is going on? One of the things I look at is the channels. Is a channel, for instance, very shallow angle? Let me take a drawing tool and I can show you a bit of a better example. Is it something like this? Of course, is a range. That's sideways. Or is the angle maybe like this? That's a weak angle. That could be anything like 5, 10 degrees. Not really relevant, the exact number, but just more of a rough feeling that this is a weak angle. And the channel like this could be correction, in fact, for probably more downside, or it could even be a end of a trend kind of scenario, right? It's in any case, it's moving up, but very corrective. A trend channel typically should have a bit of a more angled or a higher degree of angle, so that there's more, let's say, a bit more distance traveled to the up or downside. So you can see that price will be like this. Would it be more of a trend channel, right? Like that. So when a channel has something like a 30 to 45 degree angle, that's more characteristic of a real trend channel, and the trend is taking place. If it's more than that, then often enough it's not really a trend. It's unsustainable because price is really moving too fast. If something is angled like this, it cannot last forever because well, for a certain while, a few hours, maybe even a few days, yes, fine. But eventually it's unsustainable. It's too much of an angle to the upside, and price will correct probably to get an angle that is more sustainable. So what is that green part of that angle? Let me take everything out so you can see that a bit better. This channel, in fact, where you get a wider channel, it's a smaller channel within a wider channel, and that's actually an impulse, not really a trend. So those are things that you want to see for a trend channel, and you can see what is really trending or not. Part of the things you want to see in trends, number of touches. You want to see, especially if you're in an uptrend, you want to see 3 touches at the bottom in the channel, 3 touches at the bottom. You want to, sometimes a channel can cut through a bit of price, and typically you'll see price respecting the zones within that channel, the middle line, the top parts, and the quarter levels. So let me show you an example so it's a bit more intuitive. You can see here a clear, oh, let's see, that's strange. Okay. Anyhow, a bit of a pop-up. I'm not sure if you saw that pop-up message or not, but doesn't matter. Here's a channel, and you can see the purple lines indicating the top and the bottom of that channel. And you know, in this case, sometimes the channel kind of cuts through a bit of price action here and here and here, and that's okay. It doesn't have to be exactly incorporating all of that. There could be under and overthrows, and that's fine. As long as there's a good angle here, there's a good number of hits, and price is respecting the middle line, a channel like this is good. So when you look at a channel like this, you know, you could take a look at reversal trades. Obviously, in this case, would be more to the downside. And where would be a good moment to trade it? Well, obviously when the price is at the top region of this zone, right? Not so much when it's at the bottom. Trading it at the bottom to the downside would not be so smart because we're trading obviously right into the support levels. It's different, of course, if we're looking at the resistance within this channel. So naturally, when you look at channels, you can see which levels provide a potential or not when looking at this formation. Anything in the top quarter, because if you draw another line here, and here you have quarters, basically, right? So let me do that again. Let me draw these red lines. They represent quarter lines, all right? So what we're looking at, preferably for shorts, you want to be, price should be in that top quarter level, preferably. In a downtrend, price should be, for an upside trade, should be in the lower quarter. So that's one thing you want to think about. Let's see. Other thing, of course, from a certain point of view, even trading it to the upside here could be considered a reversal too. Yes, it is an uptrend, but price was making some downside here, was making some downside here, was making some downside here. This is also a daily chart. So all of that bearish price action in this zone and in this zone is quite substantial on a 4-hour chart and 1-hour chart. And you can see a pretty nice downtrend channel even within the larger uptrend channel. So even trading it from the bottom, one could consider that a reversal trade too. So even picking trades from this bottom is another way of looking at it, and channels. Now you can see dotted levels as well in that channel. Those represent moving averages, and you can see the 3 moving averages. That's a band, probably a 21 or 34 EMA band. And you can see how price responds to that, where it pulls over here, and price starts to basically pull the moving averages away from the long term, which is green. So let's talk a bit about moving averages in more depth. You can take a lot of views with moving averages. I use them very intensively, and we don't have the time to look at all those angles, but you can basically, and all those values that the moving averages have. But obviously, if price is below the moving average short term, and the short term is below the long term, you got a good trend, probably. Take a look at this recent fall in the euro dollar. We have price action below the short term 21 EMA, and below the 21 is below the 144. The space between price and the 21, and the 21 space between the 144 increasing and becoming bigger. Those are those spaces, those gaps becoming bigger, and the angles of the moving averages becoming more bearish are all signs that there's at least impulse going on. There's a lot of momentum coming into the market. And when price then starts to do this, going sideways like that, that's a correction where price is making a bear flag, and boom, we get the break. And here too, bear flag, boom, we get the break. And this short was something we talked about then and I on Monday with Dale Pinkard from FX Street, but also myself on Tuesday morning in the live trading room. That worked out like a decent trade, as you can see, moving down 150 pips in total from entry to maximum point. So those are some things. Moving averages, pretty visual, nice reference to a trend. So let's talk a bit about impulse and correction. Impulse, basically, you can see here a sketch, right? Fast price action, correction, sideways price action. So if you're taking a reversal trade after an impulse and price is not moving into your direction, but actually going sideways, it's a warning sign that your reversal trade is not going as you would like to see it. You want to see, when you take a reversal trade, after a certain period of time, and that's a different topic, unfortunately, again, not enough time for that, but I have time factor webinar that can explain that a bit more. But if price roughly after 13 candles is not moving in your way and price is going sideways, you got to be careful. All right. So you want to see within 13 candles, you want to see this. You want to see price at least move a bit into your direction with some counter impulse to the opposite side of the trend. Otherwise, you probably took a reversal trade in a range, in a sideways zone, and unfortunately in that case, there's a good chance that the trend can continue. Here's a live example of some impulse and correction, and you can see, for instance, here we have an up impulse, right? That's with the trend, but then we have a down impulse against the trend, and that itself could already be one of the signals that you want to look for that we get a bigger downside or a bigger correction. In this case, it's a correction. Why? Because we still get one more up push after that. So when you see a counter trend momentum like this, often enough you get 3 corrections. So this is 1, this is 2, this is 3. This is 1, this is 2, this is 3. So momentum and correction, very important to understand if the trend will continue or will we get a bigger reversal. Here, when we have correction, we had up impulse, correction, and indeed up impulse, trend continuation. Right? So very important, impulse correction, where and to which side this is happening, so we have a better idea about reversals. So now we have a bit better understanding. And by the way, one more thing, a trend channel is nothing less than basically connecting impulse and correction. When we have a channel like this, typically you'll see up impulse, correction, up impulse, correction, up impulse, you get my point, correction. All the trend channel does is connect those impulses and corrections to make a channel. So when you have a channel like that, an uptrend channel, we'll have typically up impulse, downside correction. Sometimes you could see even the opposite. If this is the uptrend channel, you could see something like this, up impulse, but even this occur, down impulse, up correction, down impulse, right? Point is that the channel is a bigger structure, and within that bigger structure we have momentum and correction going on. All right, so let's piece it together. These are all important concepts: momentum, correction, trend channel, and moving averages, to have an idea about the trend and at what point there's a higher chance that the trend is ending. Let's talk a bit about more of specific end of trend signals. When a channel breaks, that's a bit on the late side, but obviously could be a very strong moment that a reversal is going on, or a single trend line. We could have a channel like this, right? But a single trend line would be already an earlier break, somewhere up in here, for instance. We could have trending price becoming corrective. Here at the top, you can see price is moving up, but it's going slower to the upside. It's losing its impulsiveness. When that happens, it's one more sign that the price is losing its juice, its energy, and might not continue to the upside therefore. The other side, as I already said, counter trend is becoming more impulsive. Here we had a downtrend in play, for instance. You can see prices starting to become impulsive in this side. One of the reasons that the downtrend could be over. Plus, it broke out of this trend line and channel, another thing. And if you like ended waves, obviously when you're looking at impulse, you could label it A wave, and often enough we should see a C wave. As I said, 1, 2, 3. Divergence on the chart. One of those important reasons for finding reversals, because when divergence is on the chart, that means that the momentum, the energy is weakening. You can see at the bottom, and there are a lot of oscillators that would probably say the same, but I use the Osmo oscillator in this case. A lot of momentum in this upside, and price retraces, goes back to the middle line, makes a new push, but the oscillator fails to break the previous hump, but price does break the previous top. So we get a higher high on price, but a lower high on oscillator, and that is divergence. And divergence is a very good signal, early signal of potential of reversal coming up. Now, one divergence doesn't mean everything. It doesn't mean that right away price has to turn. It sometimes takes time, especially on the lower time frame. I would like to see double divergence below the 1 hour chart. I want to see double divergence. If it's an hour chart or higher, single divergence could be enough, but not always. An hourly chart also, it's, I would say, both can happen. A single, sometimes double is needed. On a 4-hour chart, I would say single divergence is already a lot stronger and more likely indeed to send price to the opposite direction. This is a 1-hour chart, and we have double divergence before price start to show a signal that indeed we might be getting a bigger correction. Look at this red arrow right here. That impulse already signaling the fact that this is probably part of the correction at least. Other things that could help with identifying that is major support or resistance. Obviously, if price has divergence, if price is reaching a massive daily top or bottom, or weekly top or bottom, which is support or resistance, then that is another supporting factor. You got, let's say, a key fib level here, massive resistance. You got double divergence on the hourly chart, maybe a single divergence on a 4-hour chart. You have even these are all supportive factors. You could even have a corrective price eventually, making a rising wedge, for instance, a double top on a lower time frame. All of these are extra clues that price could be making that turn. And those extra clues are very important because often enough, price really likes to test our boundaries of patience because it just keeps grinding, it keeps grinding, it keeps grinding, it keeps grinding more than we think. Pound yen is a great example of today. I was talking about the potential for a pound yen to make a downside about here, I think it was, with this break of this top. I said, I think it was this one. Let me take a look at the date. I was talking about it on Tuesday, 3rd of, no, that's the 2nd. That's Monday. So that was actually here. So I say, okay, one more break of the top will probably happen. And then we'll get divergence. And not only will we have divergence between these tops, but price is going to be in a big resistance zone right in here. So as it slowly crawls up, yes, this is an uptrend channel. We can see, right? Look at these purple lines. That's an uptrend channel. But where's price relative in that uptrend channel? It's at the top of the channel. What do we want to see? Price at the top of the channel. That's one of the things that is good. What else do we see? We see that massive resistance zone, that area right in here that could play an important part for downside. We could see, what else? We see divergence on the 1-hour chart, right? We don't have the oscillator here, but one of those things I was talking about live on Tuesday, all right? But only a single. So I said, okay, one more top of the break could happen. One more push up, we'll get double divergence. Even that was not enough. We didn't have any impulse here, just went sideways. And we had one more push up, a triple divergence to the top of that channel again. And in the meantime, we have a clear signal of a kind of a rising wedge, a pattern when you connect the dots here. The angle of the resistance way shallower than the bottom, rising wedge pattern. Now, of course, the news event today was a thing that really sent this lower. But technicals, I was just looking at technicals on Tuesday, and technicals only played out during the news event. What can you do? But those were the things I was looking at. Sometimes it happens, and technicals are just technicals. Sometimes the fundamentals will push it in our way, sometimes not. That's a different story. But in any case, those are the things that were visible, and the confluence here helped to push down. But you can see how slow and how long it took before it made that reversal, how long it kept pushing up. And that is so difficult, I think. One of the disadvantages of reversals is that it requires a lot of patience. You got to be really patient. And often enough, it's still too early. That's kind of the whole ball game here. So often it's too early, and it's difficult to find that moment where it really will make that bigger fall. All right, so now divergence is really one of the key things. I think there are a lot of good elements I hope that you get confirmed or learn here, but divergence is very important. It's leading information. It's one of the early indicators of a reversal, and yeah, it has a good benefit of understanding when that reversal could happen. Some things to be aware of here at the bottom, three things. First of all, divergence is just a good confluence tool. Of course, it's not the only thing, certainly not. Don't rely only on divergence. It is good for all types of trading, and well, if you're maybe on lower time frames, it could be good to be cautious with trading against the trend too late. That's the only thing. And last but not least, let's see, be careful of expectations. Yeah, do not have immediate effect. We talked about that already. Now, reversals kind of take place in phases. I already talked about the fact that, price makes these three wave movements. So there are different ways of trading it, really, or sometimes there's even a bigger reversal, right? You want to catch the very first turning spot, you're going to bump into the problem that price pushes further than we expected. And where do you put the stop loss? It's possible. Often enough, traders recommend to look for reversals when you at least have been trading for a few years, so that you have a general awareness of the market structure. You have more grasp about looking at the chart, maybe with less nervousness. If you're just starting, or if you're trading for a year, perhaps two, there are a lot of other things that require your attention that are automatic or more automated when you have more experience. That's just how the brain works. I just saw a documentary yesterday by coincidence about System 1, 2 brain operation. System 1 is the brain that is doing everything automated. System 2 is where we're using the logic and really thinking very deliberately. When we're doing something new, we're often in System 2. That's good, but it's slow, so we cannot handle a lot of things at the same time. So when we have more experience, we can push more things to automate it and therefore handle more aspects. That's the gist. So anyhow, difficult to catch these reversals because it still pushes and further than we expected. When you get, for instance, this first push here and a corrective sideways, you can get sometimes that third wave down. That is personally what I like to trade more often. Now, not everyone will agree with me with this, and that's good. That's why probably trading exists, because not everyone has their same opinion, luckily. I like that personally a lot, the most, if I take reversals, because I don't like the guesswork. I think it's difficult to catch the first part. It's not impossible. It's just that it requires a lot of effort, and maybe I'm too lazy for that. I don't know. But I rather just wait for a bit more confirmation, wait for the C part of the ABC correction personally, or even just wait for when it even shows stronger signs of reversals. What I'm talking about is that if you're trying to trade this particular turn, that's the first turning spot. Difficult. If you're trying to trade, let's say, the break of this spot right in here, that's typically what I would be trying to trade. And this would be perhaps the trend continuations already, because now we're already in a downtrend. If you're trying to trade the double bottom here, that's trying to be an early reversal trader. If you're trying to trade the breakout here or the breakout here, you're on the later side, but you have more confirmation. I'm not sure what these are. It doesn't say, unfortunately, but historically, most moving averages that I ever put on the chart are always 21 EMA and 34. This could be a 21 and 34 because they're quite close to each other. But often enough, I use more 21 and 144. 21 is the 21 or 34, which is like a short-term moving average. 144, which is for the long-term moving average. And what I'll be looking for, in fact, let's see if, yes, that's it. What I'll be looking for, what I consider a pullback is when price goes back to the 21 EMA. So when you see this orange here falling, you can see how price nicely stays below that 21 EMA. That's an impulsive part. That's very impulsive price action, right? And this is a daily chart. This is the big downtrend we've had on the euro dollar the last 2 years or so. And price staying below the 21 EMA. Any move back to the 21 EMA is what I call a pullback, shallow correction. Not so interesting, in my opinion, to trade it. Well, on a daily chart, it could be different. There could be still some space to the upside within, but on a lower time frame, certainly not. On an hourly chart, not that interesting to trade back to the 21 EMA. No. But if price can break above the 21 EMA, like it did here, for instance, here, this zone, right? On a daily, certainly, but a 4-hour, maybe even an hourly chart, if it can break above it and can go back to the 144, that's already more of an interesting reversal zone for myself personally, because there's more space. There's not that much space for price to move back to the 21 EMA. Often it's corrective and sideways anyhow. Look at these zones here, for instance. Once again, that's a bit different on the daily, but especially 4-hour lower, those zones below the 21 EMA in a downtrend are not that interesting because price is often enough corrective, and you got, I think, better chances of waiting for price to go back in the downtrend. But if it breaks above the 21 EMA, there's a lot more space, and that's a retracement when it goes back to the 144 EMA. And the official target, when there is divergence on the chart, is actually the price should go back to the 144 EMA. That's my rule of thumb. For a 4-hour chart or higher, and double divergence for a chart lower than the hourly, and the hourly is kind of in between that. So if price breaks above the 21 EMA, it targets the 144, and that's decent reversal territory in my opinion. Obviously, if price then starts to break above the 144 and drags the moving averages to the opposite direction, something like it did here. Don't forget that here it still was an uptrend when you look at the moving averages, but when the moving averages are starting to be dragged to the opposite side, price is still consolidating and then breaks lower, it's the start of a new trend to the downside. That is the first reversal or first trending side to the downside, or one of those big reversals when considering this entire move down. Because here we're still up, and now we're moving down. So some general comments, difficult for the timing, as I said, slow, but then all of a sudden, out of the blue, the reversals can really speed up and be very fast. Look at the pound today, boom, right? Big move. Some news event perhaps can really speed things up. And often if you want to try to catch that first part, you're either too soon or the move has already happened and you're too late. That's what I see often is just as the biggest disadvantages. The timing especially is very tough. I'm sure it's possible. It's just that I don't want to put in all that effort into trying to catch that. You got to have a good knowledge of market structure. Requires a good knowledge of divergence. Stops are pretty small, and it's easier to pick bottoms than tops, perhaps. But what I look for, as I said, I rather go find the movements like here, for instance, when it starts to break above the 21 EMA. Those are more interesting zones for a reversal. Basically, here we already it's basically not that first upside, but more like if there's a zigzag, for instance, a zigzag correction, price is moving down, does like this, and then moves up. Now, one of the reasons I also like that is my time factor rule, which is something we don't have time for today. But time factor, if 5 to 6 candles very quickly don't break this impulse to the downside, and we get an upside and a downside, if 5 to 6 candles don't break the previous momentum, then there's a higher chance of a bigger correction. I use that often for a reversal trade to the opposite direction or to close the trade with the trend. That's why I like that weakness kind of, I like to trade that a lot more than this, also because of my time factor method that I use. And I got 2 webinars on that, by the way, so that I can share with you. Write an email to, let's see, I'll quickly write my email address if you would like to know more about time factor, because we're not going to be able to cover that, because Ned has some good stuff prepared too. So there's the email that I sent in the chat, or you can write to, it's not working there, my name, which is CHRIS _ my surname, and then at, and then you have to do hotmail.com. Hotmail.com. Okay. So anyhow, entries and exits, some classical things you can think about. Fortunately, not much time left, but anytime you see a pin bar, well, those are indeed, under certain circumstances, pretty good. You could try to trade price back to the 21 EMA or support or resistance. Pin bars are one of those things that definitely show price action and exhaustion, especially if you have a good run up of upside candles. If you have 5, 6, 7, 8 candles like that, and then boom, you have a bar like that with a good wick on top, a close that's bearish, and preferably into the previous candle. Could be a very good signal, right, to take that to trade as a reversal. I think that could be indeed one of those early signals that's not bad. Or one other thing could be to put a fib on this impulse, wait for price to hook back, wait for the time factor, for instance, try to take the fib bounce down to the targets, right? Or wait for a candlestick pattern off of that fib. Or use the channels, as I already said. I think that's the last chart, and then I'm going to pass it over to Nene. Let's see. This chart is saying, okay, the trend is down, clearly, right? What do we see here? We see price breaking out of the trend with an impulse, and then we get a wedge. So what does that mean? Yes, the trend is down, but the impulse is up, and then price corrects back down in a correction, which is more of a triangle. So if price breaks that triangle, if it breaks that chart pattern, there's a good chance that we could get the third leg. Remember I was talking about 1, 2, 3s or ABCs for those that like waves, and that's the formation that could be traded. That could be a reversal trade, a very good one, up to the minus 61.8 target, as you can see. All right, and the minus 61.8 target itself could again be a good reversal trade for maybe a move back down, right? Depending on circumstances. Because maybe that 1, 2, 3 is just a correction, and then the downtrend could continue again, like it did here. But take it case by case. Obviously, look at the overall structure to see if that could happen in similar points. If it is a 1, 2, 3 correction, the trend can continue. If it's a total reversal, then we would see probably price make a correction like this, some kind of flag, and probably price will continue to the upside. That's how you can know the difference. All right, that's my part. I'm going to hand it over now to Nenit. Let me see if I can get the charts over to him.
Thank you, Chris. So that was excellent presentation. Now I will continue and I will show you basically a very simple way how to spot whether you have reversal or retracement. So today we're going to talking about reversal or retracement, candlesticks, and live chart examples. I will give you some chart examples. It's pretty much easy, I think, and you can definitely be sure that by using these examples you can predict whether it's reversal or retracement, and you can trade it. At least you can try to intraday trade it, which is a good thing. Now I know that there is a big problem for a lot of traders to distinguish there is a price change or it's just a retracement. Usually when I get an email, it's a question, is it a retracement or is it reversal? Where is euro dollar going? Is it going down? Is it going up? So definitely that confirms my doubts that traders simply do not distinguish between two simple things, whether it is retracement or reversal. The crucial thing is, the ultimate answer to that question is you always need to watch higher time frames. So do not forget, guys, trend can exist even on 1 minute time frame. Okay. Do you remember our first class and of course first price action trading school class when we talked about trends? Trend is just a simple zigzag. Okay, trend is just a series uptrend. It's just a series of thrust and pullbacks. Okay, thrust, pullback. It's a series of higher high and higher low. Okay, vice versa for downtrend. Okay, you have a bearish zigzag, which is exactly lower high and lower low. So when you see a zigzag, when you see this pattern, you know that there is a trend. Now, those patterns can exist, as I say, on 1 minute time frame. But you don't want to take a look at 1 minute to confirm a trend reversal. Of course, 1 minute is hectic. It's a whipsaw time frame, and everything can happen on 1 minute time frame. But if you watch daily time frame, if you watch 4-hour time frame, that will be enough for you to trade during the intraday. So you will know that the trend is going to change intraday. Then you need to take a look at weekly. Sometimes you can take a sneak peek at monthly chart. But the thing is, you always want to watch higher time frames to distinguish whether it's a trend reversal or not. And we are not talking about the minor trend reversal, let's say 15 minutes. Because sometimes on 15 minutes, you can see that the trend has completely changed. While on 1 hour or 4-hour time frame, there is still a trend, right? And sometimes you might get caught into that trap thinking that you should short on 15 minutes, while actually it's a support on 1 hour and the price can bounce off. Usually the thing is that you can take a peek if you're trading intraday, which I suppose you do. Then definitely you can watch a 4-hour time frame. It's pretty much enough. But if you see that the price is indeed retracing a bit and you want to go in a trade, take a look at the daily just to see whether there is support or it's just a retracement. It's not hard. You just need to get used to it. Forget about a lot of those indicators which can tell you, I don't know, a lot of traders is saying if RSI is above 50, we are in uptrend. If RSI is below 50, it's downtrend. It's not simple as that. I don't believe those kind of numbers. The only indicator I have used so far for telling me the actual trend, you know what the indicator is, it's MACD. And usually MACD can capture the trend, and because it's a lagging indicator, definitely you can say that there is a loss of momentum, that there is trend. I explained that yesterday on my CBT class, MACD, how you can use it. We will have more of that, of course, but the thing is that you can also watch for price zigzags and for price literally for price patterns. It's just simple as that. Carolyn is saying that he noticed that me and Chris do not use indicators with overbought and oversold zones. Of course. And you know why we don't use it? It's simply because the price can stay in overbought and oversold for weeks. It's not that simple. Sometimes if you see that the price is in overbought zone, just because indicator is telling you that it's overbought, you think now it's time to go short, and it won't drop, and it still goes higher because it can stay for weeks in overbought or oversold zone. There is no overbought and oversold zone in a literal sense, in that sense, indicator sense. It's just a fancy word for indicators. If it's above 80, we are in overbought territory. If it's above 20, we are in oversold. I don't call it overbought or oversold. I can just say there is a cue for you to look whether the price can turn from those points. Stochastic is great. CCI is great. But I don't trade just purely because stochastic told me the price is above 80 or it's below 20. It's just a cue, one part of the confluence which can tell me that the price is going to reverse. Of course, with our HARP system and HARP method, I don't know if you are familiar with HARP, you can always watch our HARP live trading videos, which we made. We, of course, use stochastic, but it's just a cue for us. It's just a simple one point of the confluence where we can say that the price will reject or it might go up or down. So it's just a part of the confluence. But if you trade price action, let's say you want to trade price patterns and price behavior patterns, you don't watch any indicator except maybe few, let's say MACD or some people use the RSI. I don't use it because overbought and oversold, for me it's about resistance and support. If I see that the price is really going towards historical resistance, I just flip my chart to the left. I was teaching you guys. I was teaching you in a lot of classes. Really, you remember, you just need to flip the chart to the left and see whether there was historical selling. So let's say that the price is going up and your stochastic is still in 80. Now, what would you do? You would really randomly open a sell trade just because stochastic is in 80 territory. No, it's not. It doesn't go like that. So the price is going up, you open one time frame or two time frame higher and see if it's very close to resistance. Watch to your left. If you see that that was the zone in the past which rejected the price, the odds are that it will reach the zone and it will be rejected again. That is for me overbought and oversold. I not literally, but that is basically where I expect the price to reject. I always watch history. History repeats itself. So that is how I do it. And all reversals start from trend. Do not forget, you don't know whether if it's reversal or just a retracement. Okay? You don't know that. The path is trend, retracement. Okay? Still, we are still in a trend. And then reversal might happen. So before reversal, you will always have trend and you will always have retracement. Reversal is the last of three. It comes at the third place. It follows trend and retracement. There is no reversal until there is a trend and retracement. But you don't know, right, whether it's reversal or not. Well, that's the point. Reversals are usually preceded by price patterns. For example, if you see that the price is going up and it starts to retrace, well, usually after first retrace, there will be again a trend continuation. But then if you see in uptrend that the price has made a lower high and it continues to go past the previous retracement point, you might think that there is indeed a reversal. But you can also use candlesticks for additional confirmation. Okay, price is falling down towards support. You see piercing line pattern. You see that there is a big support. You open your time frame higher or two time frame higher, higher time frames, and just watch the price action in the past. You see that this is indeed a support zone which rejected the price in the past, and then you are followed, basically the price is followed by a bullish piercing line. That is double confirmation that indeed we can have a retracement. It's called candlestick reversal, but the odds are if the price was falling like this, it can reject, and here maybe with Fibonacci and other price confluence, it can still go in the favor of the trend. but then maybe it will reject. So the first cue for you is to watch for rejections at historical price levels, at historical support and resistance, and try to spot a confluence with divergence and candlestick reversal patterns. Yes, head and shoulders, but Carolyn is saying head and shoulders, inverted head and shoulders. Yes, if you see, let's say that if you see a 15-minute head and shoulder, okay, but maybe on 1 hour or 4 hour, it will still be a trend. So you cannot, you need to distinguish. I always say, guys, you need to know the time frame. Do you trade 5-minute time frame or you trade 15-minute time frame? Because head and shoulders on 15-minute can reject the price, but the price can again go in trend direction on 1 hour time frame. So you need to think about it. 15-minute is not that strong as it is 1 hour time frame. Okay, so it does not necessarily mean that the price will reverse. Notice that my analysis is usually 4 hour time frame, and it's very often it's very accurate. If I did my analysis on 15-minute time frame, I doubt it would be that accurate. So you need to understand the point of time frames. You cannot say the price is, the trend is going to reverse. I never understood those kind of statements. Which time frame? You cannot say that the euro dollar is in uptrend if you see that 15-minute time frame went to the upside. What about daily? What about monthly? What about weekly? What about 4 hour? A lot of traders think that just because euro dollar went to 1.1100 that the trend is going to change. It will go. I have even heard some statements that it will go to 1.200. It was 2 months ago, and now where we are closer to parity, then it is going to go to 1.2. I'm not saying that it will not go, but you need a confirmation. You cannot just speculate because 4 hour was going up that weekly will go up, right? You need to watch. That is why I say always react to the price. Don't be clairvoyant. Don't try to be only a magician, having a crystal ball, and your crystal ball is telling you where it will go. It's just a random opinion. If you want to do the analysis proper way, you always need to watch a correlation between time frames. And based on that, you can pinpoint your target. Okay, we see that on 15-minute price is going down. You want to take that trade, great, but take it on 15-minute. So you want 15-minute to go down, pick a 5-minute trade, I don't know, because 15-minute trend is going down, and probably you will get 10 pips. But do not think that you can make 50 pips, 60 pips with that. Open 4 hour time frame and watch the general trend. If you see that 1 hour is in uptrend, watch 4 hour. 4 hour is down. Okay, there surely be, in 80% of the time, there will be a rejection. What did we talk about yesterday? We talked about loss of momentum. It's called retracement. Multiple time frame analysis. 4 hours is going down. You want 1 hour to go up, right? Because you will trade a bearish short trade on 4 hour. That is why you want 1 hour to go up. You cannot say just because 1 hour is going up, okay, I will buy 1 hour time frame. It's already going up. So if 4 hour is going down, you will use 1 hour loss of momentum to actually put a short trade on 4 hour time frame. Okay? And these are all examples of these patterns. Bullish tree inside up, bullish hammer, bullish inverted hammer. Notice the previous price movement. So bullish piercing line, price was going down, and now this is time for rejection. So we are having a retracement. Price was going down, okay, rejection, 3 inside up. We are having a retracement. Bullish hammer, price was falling, it made a hammer, possible retracement. Bullish inverted hammer, price is going down, great, we are probably having a retracement. Bearish dark cloud, price is going up, okay, dark cloud, we are having a retracement. Bullish piercing line, and so on. Shooting star, price went up, okay, now it's time for retracement. Bearish engulfing, price went up, it's time for retracement. White Marubozu, usually you know how we traded. 61.8, 78.6, 88.6. Price should reverse. So guys, always think about higher time frames. Watch for rejections from support or resistance. It's called a retracement. You don't know whether it's retracement or a reversal until reversal is confirmed. When support is broken and retested, it becomes resistance. When resistance is broken and retested, it becomes support. Then price should follow new trend. New zigzag will follow up. It's more reliable on higher time frames. This is how it looks. This is a scholastic example of a 4-hour trend change. Okay, so we are talking now about 4-hour trend change. We are having a strong uptrend on 4-hour. You can see it here. This is indeed a strong uptrend. Look. And now let's say that you want to take a trade around, let's say that this is a start of retracement, which is indeed a start of retracement. Just take a look at the top. You see how this candle ate almost 2/3 of previous candles. And you think, okay, now the price is going to retrace. You put your Fibonacci and watch 4-hour. Now, 1 hour at this time is going down. Okay, 1 hour is going down. So look at this. 4-hour is still up, right? Because this is your, let's say this was low, this was a high, then this was another low, and definitely this was a higher high. This is trend pattern, N. Look at N letter. Look at W bearish. This is Adam and Adam pattern. So everything is saying, guys, that is why you need to know a lot more about price than it's just a system or a method. Or let's say system, method is more complicated. So this is Adam and Adam pattern here. This is breakout. This is trend, N letter, okay? This is very clear uptrend. Look at the momentum from these price candles. And now this is time for retracement. Price is going down, 1 hour time frame is going down. So you want to wait if you want to trade 4-hour. Look at candles. Look at 78.6 rejection. Okay, look at this trend line here. Okay, look at rejection where this is naked trading. This is no-brainer trade. Look, double bottom, rejection from a trend line at 78.6. Okay, the price will go up, and it went up. It went up for 200 pips or 150 pips. It doesn't matter. It's enough for you, right? It's enough because you are happy with 100 pips. Let's say that you made your pips. But then you see, this is a high, but the price has made a lower high. Look at this. This is high, this is low, right? Now, this is a lower high, and look at this. This is a higher low. Now, you think maybe the price will indeed reverse. Watch this trend line, okay? What happened? Price has made another lower high, another lower low, another lower high, another lower low. And here, at the trend line break, you wait for a retest. What did I say? Price, when support is broken and retested, it becomes resistance. Okay, this is support. It was broken. This is retest, rejection. And look, at this time here, the price has made a first zigzag in a new trend. Until here, we had bullish trend on 4-hour time frame. At this point here, we know that we knew 80% that this will be a trend change here. And trend change is confirmed here. And now look at this, what happened. High, lower high, okay, then lower low, lower high, lower low. Another retracement which is indeed lower than this point here, okay. So this retracement is still beyond this price rejection. So this is bearish inverted N. What did I say here? A new zigzag will follow up soon. Okay, the price is following a new zigzag. Do you remember when I told you guys that the price can indeed go to, it was analysis Australian dollar a couple of days ago, that it will reject from this point. Okay, and what happened? Just read my analysis, Caroline. I will show you if you don't remember. Let me pause the screen. And that was a scholastic example of a price change. And because I know that a lot of people again thought it would be uptrend, but well, I said Australian dollar bears are patiently waiting, and that was I did this on purpose. Okay, I did this on purpose. Okay, POC1 rejection from this spot. Even if the price went here, I would short it again, because look at this. This was obviously a trend change. Look, the pattern, and the price has rejected from POC1 for almost 100 pips. Okay, and that was it basically. That was it. New zigzag was formed. Okay. And you have a downtrend here. The only way we can say that the price will make another uptrend is if it breaks this high here and starts to go with a new zigzag. Until then, this is downtrend. Okay? And that is how you should pay attention to reversals. I know it's a lot easier with indicators, but this is price action. This is how you do it with price action. So do not pick the levels randomly. Wait for divergence, candlestick, or trend line breaks. Divergence is the first cue towards price retracement or reversal. Divergence. Support or resistance retest and continuation, as I explained. Regular divergence is trend retracement or reversal. Hidden divergence is trend following. So regular divergence only for spotting a possible price change. Remember, trend exists on each time frame. So do not ask questions, is euro-dollar trend going to change? Of course, you need to ask, is euro-dollar 4-hour time frame is going to change, or 1 minute time frame is going to change? Because trend exists on each time frame. This is an example of regular bullish divergence. MACD making basically a higher low, and the price has made a lower high. Oh, sorry, not lower high, lower low. And exactly at this spot, you can see it here, this is when price has made a lower high here. And the price started with retracement. This is retracement. This is retracement. And now look, 15 minute, guys. At 15 minute, at this spot, which is approximately 78 or 88.6 of the overall retracement, the price has turned into a trend direction. Yes, I use MACD, but also I found CCI that is very, very reliable at spotting divergence. We will talk about it on our price action training school, but indeed, it's accurate. But you see here, this was a retracement here. This was retracement here, guys. Now this is a right trend entry here. Look historical selling from this spot. Look that it is close to H3. Look triple rejection and probably 78.6 or 88.6 retracement. So guys, look at this. This is basically telling you that this is just a trend continuation on 15 minutes. And a lot of people would think, okay, this is uptrend. No, because this is high, this is low. This is just a lower high compared to the overall M15. Okay? So guys, this is how you do it. And now I can show you a live chart example. Let's say we can use, I don't know, we can go with the New Zealand dollar. Okay, New Zealand dollar, for example, another good example. This was uptrend. Look, huge uptrend. Now, if you put Fibonacci retracement, okay, I will delete this one. And let's say that we want to take a last trade, which is this, okay? Focus on this point. Because after this, you probably think I will go long. And you're right, you want to go long. This was previous top. You go with Fibonacci. Double bottom, right? Okay, and look at this. Okay, the price, I would probably enter around this spot here, okay, in this zone. So the price has made, I wouldn't look for shorts at this spot here, okay. I'm talking about this spot, and I will show you why. I would never look for shorts because this is a retracement in uptrend, and this is pin bar rejection. This is pin bar rejection. So if I made my entry here, I would have gone 57 pips in a drawdown, but after that, the overall pip point potential would be 112 pips, 12 pips, okay? So this is uptrend rejection. But because price has failed to make another high here, we are starting to look at a possible retracement. We put a trend line here, and we can easily identify that we have basically a series of lower high, lower high, lower high, lower high. Okay? So we have lower highs. Now I would put another trend line here, or let's say I can make it here also. Okay, it's better. Like this. Okay? Here and there. And look at this now. Price has indeed gave us a profitable trade here, but it has failed to make another high. Then it started to drop, another rejection here, but look at this. It's another rejection just after this price. So the price has broken a trend line. It made a retest and proceeded to go down. Until this spot is taken again, we can say that this is zigzag. Price is following zigzag now. We can say that New Zealand dollar now is in downtrend. And if you remember, a week ago I said that 67.40 was good for shorts. And indeed the price, this was the time when I told you to go short. The price went 50 pip in a drawdown, then it went a lot of pips in your favor, 180 pips after the analysis. If you remember New Zealand dollar, check it on Admiral Markets, I was implying that the price should go down. It went 50 pip against us and then it went down. This is a scholastic example of how you can trade and how you can spot a reversal. Guys, we are already over the time. Of course, we will talk a lot about this at our price action training school. If you have any questions, do not hesitate to ask me. I hope that everything is clear. You need to practice this. This is how I usually go when I want to make intraday or intra-week trade. But just imagine that you can do this even on 15-minute time frame. It just depends on the time frame you want to trade. Even 1 minute time frame, guys, even 1 minute time frame. Okay, now look, I opened 1 minute and okay, even 1 minute has a trend. Look, this is a trend on 1 minute. So always think which time frame you want to trade. And then you make your decision. This is how you do it, no matter of the time frame. The principle is the same. Thank you, guys. I don't see any questions. Thank you for listening to us. We will talk about this even more. Feel free to ask if anything is not clear. We are here for you to help you. Cheers, guys, and see you on Monday. Trade safe.